The cryptocurrency market is flashing red today. Bitcoin, the largest cryptocurrency, has tumbled below $75,000. This marks a significant drop from its recent highs. Investors are concerned about a confluence of negative factors. Global economic uncertainty and political events are shaking investor confidence. This essay will explore the key reasons behind the current crypto market crash. The total cryptocurrency market has lost billions in value. Many altcoins or alternative cryptocurrencies are down even more than Bitcoin. Ethereum, the second largest cryptocurrency, has experienced a steep decline. This widespread sell-off reflects a broader trend of risk aversion in the market. The crypto market is known for its volatility. However, today's crash is particularly concerning. The speed and depth of the decline have caught many investors off guard. Some analysts believe this could signal a longer-term bear market. Others suggest it's a temporary setback. This situation is rapidly evolving, and it's too early to predict the long-term impact. However, understanding the key factors driving the current crash is crucial. This analysis will delve into the specific events and market dynamics contributing to the downturn. President Trump's recent announcement of new tariffs has sent shockwaves through global markets. These tariffs target a wide range of goods from China, Vietnam, and the European Union. Investors fear this will ignite a global trade war. Such a conflict could have devastating consequences for the global economy. The tariffs have already sparked retaliation from targeted countries. This escalation is fueling uncertainty and fear in the markets. Investors are particularly concerned about the impact on inflation and economic growth. The tariffs could lead to higher prices for consumers and businesses. This could dampen consumer spending and slow economic activity. The probability of a recession in the United States has surged in recent weeks. Economic indicators are flashing warning signs, and market analysts are increasingly pessimistic. The stock market has already experienced significant declines, with major indices falling sharply. This negative sentiment is spilling over into the cryptocurrency market. The tariffs are just one piece of a larger puzzle of economic concerns. The Federal Reserve's monetary policy, rising interest rates, and geopolitical tensions are also contributing to market uncertainty. These factors are all interconnected and are creating a perfect storm for a market downturn. As economic fears mount, investors are engaging in what's known as risk-off behavior. This means they are selling off riskier assets, such as cryptocurrencies and stocks, and moving their money into safer havens. These safe havens typically include government bonds, gold, and the US dollar. Cryptocurrencies are considered high-risk assets due to their volatility and lack of regulation. During times of economic uncertainty, investors often shy away from such assets. They prefer the relative stability and security of traditional investments. This flight to safety is putting downward pressure on cryptocurrency prices. Institutional investors are also playing a role in the crypto market sell-off. These large players such as hedge funds and investment banks have been increasingly investing in cryptocurrencies in recent years. However, they are now reducing their exposure to the market as part of their risk-off strategies. The decline in institutional investment is further exacerbating the downward pressure on crypto prices. This is because institutional investors typically trade in large volumes, and their selling can trigger a cascade of selling by smaller investors. Two key factors are amplifying the price movements in the cryptocurrency market: high leverage and whale activity. Leverage refers to the use of borrowed funds to amplify potential returns. While this can magnify profits, it also magnifies losses. Many traders in the cryptocurrency market use high leverage to increase their exposure to price movements. However, when the market turns against them, their losses are also magnified. This can lead to forced liquidations, where traders are forced to sell their positions to cover their losses. These forced liquidations can trigger a chain reaction, pushing prices down further and triggering more liquidations. This is particularly true in the cryptocurrency market, where prices can move very quickly. Whale activity is another factor contributing to the market volatility. Whales are large investors who hold significant amounts of cryptocurrency. When whales buy or sell, their trades can have a significant impact on the market. In the current market downturn, some whales are selling off their holdings to take profits or to reduce their risk. This selling pressure is contributing to the downward price spiral.